Hey everybody, it's Jack and welcome back to another video. Today's video is going to be a little bit different than some of my past ones. I'm just going to be having an open discussion about the current state of the stock market. I'm going to be covering a lot of different topics such as, is the stock market crashing? What's going on with the volatility in the stock market? What's behind it? And what does it mean going forward into the future? And I'm also just going to be going over some tips and tricks and really just some key things to remember as a long-term investor to really just keep your wits and not be fearful in times like these. I'll then touch on how my personal investment strategy is kind of altering because of the current state or environment of the stock market. I'll also be going over what stocks and sectors I think are currently still really great buys in the current environment that the stock market is in and going forward, and why that is, and maybe some stocks to avoid or certain things to look at when investing into stocks today, and certain red flags or warning signs that you can look for before investing. So really a lot of information. I hope you guys enjoy this video and find it informative, and let's jump right in. So the first thing to cover truly is just the state of the stock market. We've really started to see some volatility and swings up and down in the stock market over the past few weeks, leading into this week where it was no different and actually even a bit worse. We started the week with quite a significant sell-off pretty much across the board. We saw the S&P 500 drop around 4%. However, it did rebound yesterday, which is a good sign. We saw tech continue to sell off, and we've even seen growth stocks get beaten down extremely hard over the past few days. So what's behind the sell-off this week and what's causing this downwards momentum? Well, it came out earlier this week that inflation seems to be on the rise, which shouldn't really come as a huge shocker to anyone, since both the Canadian and US economy have really been funneling and pumping money into the economy over the past 12 months. So it really shouldn't be a huge shocker that we're starting to see inflation rates. However, it's not strictly the fact that inflation rates are rising that is the problem. It's really the rate at which we're starting to see the increase in inflation. We saw quite a significant increase over the past month, with the reports coming out that in the US that inflation is up to 4.2% for the past 12 months. And this jump in inflation is the highest we've seen since 2008, which, as you all know, was another market crash. So we definitely cannot take that as the most positive sign. And that is definitely why we're starting to see some downwards momentum in the stock market. An increase and rise in inflation rates usually always leads to an increase in interest rates, as it's one of the only really things the government can do to help combat inflation. And this is not usually a good thing for companies and investors, primarily companies, when it comes to the fact that for the majority of companies, they actually leverage debt in order to grow. So if interest rates rise, it makes it much harder to pay off those debts and actually leverage debt. And this really begins to chip away and eat at revenues and profits of companies, specifically those high growth companies that really utilize that leveraging of debt to help grow their businesses and get them more profitable to really help kickstart their journey and growth. So that's definitely one thing to keep in mind. Companies that leverage debt in order to grow their business, which usually is like high growth companies or growth stocks, but not only those. Sometimes dividend stocks do this as well. The majority of companies actually do. They leverage their debt to grow the business, which is just a common practice and it's not out of the ordinary. But this definitely becomes a little bit trickier with the rise in interest rates. This chart kind of goes to show how when inflation rates can get out of hand, how the inverse or negative effect it can have on earnings of companies. And this can be seen through the price to earnings ratio. That is the green line in this chart. And the blue line is the CPI, which basically is inflation. So I'm not saying that inflation is going to get to these rates that you can see marked in red at that 15%, 10 to 15% range. But it is interesting to look at this and see the correlation between inflation and price to earnings, the average price to earnings of companies. And we can see that, usually when inflation gets above that 5%, it does start to get out of hand and get even farther up, which then leads to the drop off in price to earnings ratio. So this is just a good visualization that kind of shows the potential impacts of the rise in inflation. So on the topic of inflation and interest rates, how does this kind of affect the stocks that you should be targeting or potential sectors? Well, you're definitely going to want to look for sectors or stocks in particular that are hedged against inflation. So what exactly does that mean? Well, if you think about it, if prices of certain items start to go up or certain commodities, what kind of stocks would benefit from this? So definitely any commodity related stocks. So we're talking about, gold, copper, lumber, things like that. So any of those material stocks are seen as commodity stocks, and they usually do pretty well when inflation rises. And there's many more commodities out there. Another type of stock that works well as a hedge against inflation is actually railroad stocks. These are stocks I just featured on the channel in one of my previous videos. I just touched on Canadian National Railway. So if you're looking at the railroads as a play, they're definitely one that I think is a good one, because as the prices of commodities, go up with inflation, the actual price that these companies can pay for the transport of their products also goes up. And the railroads are really just a backbone of this. So I think they are definitely a decent play. We're also going to talk about utilities companies. I think utilities companies are also another good play against inflation, because if you think about it, everyone's going to need power, electricity, all of those things. And as inflation increases, these utilities companies can also increase their prices in order to combat this. And the majority of utilities companies actually have long-term contracts that already have kind of an inflation hedge built into them to account for this. So these companies are usually going to be better off in the long term when we are starting to see periods of higher inflation. So once you have a company in one of these sectors or a specific stock that you think is going to be a good play for battling inflation, like I mentioned, you're going to want to look at how this company is leveraging debt. So you're actually going to want to look at their free cash flow to see if they are taking on debt or whether they're actually being profitable. And the way you can do this in Yahoo Finance is to go to the financials tab. And yes, the balance sheet is one good place to look. You can look at their current assets to current liabilities and really start to look at the current liabilities, whether there's a lot of debt on the books. But I like to go to the cash flow tab. You just click on cash flow, and then you can look at the breakdown. And if you scroll all the way to the bottom, you can see the row for free cash flow. And really, if this number is positive, it means that the company is generating cash. And if it's in the negative, it means the company is taking on debt. So it's really just a good indicator for a stock that it can maybe be a better move against inflation for one that's not leveraging lots of debt. So really checking this free cash flow and making sure it's positive is really going to be a good sign for your stocks going against inflation. Definitely let me know down below in the comments section what your go-to stock for a hedge against inflation is. Is it a certain type of commodity stock? Is it a utility stock? Maybe the one that I mentioned. Definitely let us all know down below in the comments. What kind of stock do you think is a powerhouse when it comes to combating inflation? We're definitely curious to know. The second kind of touch point that I want to go on to and talk about is the fact that you really just can't time the market. No one has that crystal ball that lets you see into the future. So you really have no idea what the future has in store for us. We could see things get worse, and they very well might. We might see things continue to sell off. They might continue like that for a month, could be even be a year. We really just don't know. And really the thing I want to really get across to all the viewers, and what I tell myself every single day, is you can't be fearful of the stock market when it's going down. You actually have to see that as an opportunity. And in the long run, dips and crashes are actually going to be your best friend if you can actually take advantage of them and use them to really help further yourself for long-term gains, because really those are the best opportunities that will come to you in your lifetime, and being able and being ready to take advantage of them is really going to help you leapfrog the competition and really boost your financial status in the long run. And I'm going to pull out a famous quote from a legendary author, Benjamin Graham. If you haven't read this book, The Intelligent Investor, I definitely recommend picking it up. It's one of my all-time favorites. It is a little bit dry in certain areas, and if you're a beginner, some things might be hard to fully comprehend. But this is really a book that has so much useful information for any investor. There's so much to take away, and I highly recommend picking it up. The Intelligent Investor by Benjamin Graham. So here's the quote. It goes, "The intelligent investor realizes that stocks become more risky, not less, as their prices rise, and less risky, not more, as their prices fall. The intelligent investor dreads a bull market since it makes stocks more costly to buy, and conversely, so long as you keep enough cash on hand to meet your spending needs, you should welcome a bear market since it puts stocks back on sale." And that quote really just goes to show and highlight that as stocks come down in price, for the long-term investor, they are actually more favorable investments at those lower prices. They should actually be seen as a sale and a greater buy, and you should actually be more excited to invest than when you're investing when stocks are going up and hitting those all-time highs, because those are actually riskier investments when stocks are doing well, and when stocks are not doing well, they're actually seen as a better investment, or at least should be. Of course, this still depends on you investing into a really rock solid company that you've done research and due diligence on, not just buying a crappy company on a huge dip, because that's not going to lead to any upside, and that's definitely not going to help you in the long run. We're talking about really solid companies that have really bright futures and that you've done your research on and that you have a reason for investing into these. And a specific example of kind of how you can kind of visualize this value in terms of a dividend stock is when a dividend stock actually comes down in share price value, the actual dividend yield, so the actual percentage that you're getting of the stock's value actually goes up. So that dividend yield increases as the share price goes down. You can lock in those higher dividend yields. And then really just another thing to tie on to that point is that I'm implementing as one of my strategies. As you notice, I do weekly updates, but I'm also investing weekly and just dollar cost averaging into the stock market and in my positions over time. And again, I know I'm going to hammer it home. One of the famous quotes that time in the market beats timing the market. I've said this before, but I truly do believe that not being fearful, not selling all of your stocks, staying in the positions that you believe in and that you've done the research on in the long run leads to success. And the results show that by actually missing just a sliver or a few of the best trading days will actually significantly impact your results. So if you sell out, you miss one of those rebound days where the stock market jumps up a few percent or whatnot, you're actually going to be missing out on that. So you may have seen this diagram before, but it goes to show the extent on the S&P 500 over a 20-year span if you were to miss some of the best trading days and how it would affect your overall returns. So if you stayed in the market the entire time, you would average 9.85% as your return on an annual basis. If you missed 10 of the best trading days out of those 20 years, your return drops from 9.85% to 6.10%. And then it just starts going down from there the more days you miss of the best trading days. So you can really see how time in the market beats timing the market because you just don't know when one of those best days is going to be. And that is key. So by just staying in the market and making sure that you capitalize on those really good days can be a huge plus. So how is my investment strategy kind of changing and morphing because of the current market environment? Well, I'm going to start to simmer down on adding to some of my higher growth kind of penny stock positions, as those are the companies that really leverage debt, like I talked about, in order to see that growth. And with the potential continuous rise in inflation, is really going to start to hinder some of those higher growth stocks and actually put them at a much more higher risk than when I initially invested into. And I'm also just going to be continuing to add on to my dividend stock positions, specifically instead of in those growth stocks, moving it over to dividend growth stocks. So those dividend stocks that offer the lower dividend yield, but at least I have the safety of continuing to get paid by my stocks, even if the stock market goes down. Again, you're just going to continuously have that kind of safety net and at least making sure that your investments are earning you money as you kind of wait things out and really start to wait out the volatility in the stock market. And again, in the long run, everything will work itself out. So I really want to hear from you guys. Let me know down below in the comments what your strategies in this kind of market environment currently. What are you guys doing? Let us all know down below. Hopefully give some tips. Maybe I'll take away some things from you and maybe hopefully you've gotten some stuff from this video. So that's it for this video. I'm sorry if I rambled. I just thought this would be kind of an informative and fun video and really just want to open the discussion and open the floor for you guys. So definitely make sure to comment down below. But again, I hope you guys enjoyed this video. If you did, smash that like button, subscribe to the channel. It means a lot and really helps the channel grow. And I'll see you in the next one.